Financial planners, do you have clients opposed to attaining or don't qualify for long-term care insurance? Hi, I'm Angela Conrard, certified reverse mortgage professional. As a financial planning professional, you know the statistics. 7 out of 10 people will require long-term care, but less than 3% will buy policies. Perhaps they view the premiums as too expensive, or generally they're just opposed to getting a policy. Well, I have an alternative for you. You can offer your clients an alternative to using the magic of compounding growth in a credit line with a reverse mortgage. Most of your mass affluent clients will probably own their own homes outright or have little debt on their homes. Let me show you how this works. In this illustration, we're going to assume our homeowner is 62 years old. Their home value is $500,000 and they don't owe anything on their home. To attain a reverse mortgage, there are one-time closing costs versus with attaining a long-term care policy, you have ongoing premiums. So this is one of the advantages of using a reverse mortgage to self-insure potentially for long-term care. Our estimates, our initial balance and closing costs will be an estimated $18,258. We will set up a credit line of $172,742. And our estimated credit line growth is 7.2%. Again, this compounds if these funds are unused. Now, and it's also important to remember that these funds are tax-free. They can be taken out at any time. Let's jump 10 years forward. Our $172,000 has grown to over $366,000. And by age 82, let's scroll up a little bit here. Our credit line has grown to over $789,000, and by age 85, in the year 2046, our credit line will have grown to over $990,000. Our annual loan care costs for this person is going to be between $125,000 to $199,000 a year. And again, according to Genworth, they'll need between 6 months to 3 years of care. Now let's look at maybe an illustration where our client owes a little bit of money. Okay, we're going to assume this age 62 and our home value is the same, $500,000. But this client is still working and they still owe $80,000 on their home. And they're very comfortable in making their payments. So they've decided that they're going to attain the reverse mortgage because they want that liquidity, and they're going to continue to make their payments into the reverse mortgage for 10 years. In the course of attaining a reverse mortgage, if you owe anything on your home, that loan balance is paid off out of the amount you qualify for, and anything left over can be set up into a growing line of credit, and that's what we've done here. Our line of credit estimate is going to be $92,742. Our initial loan balance $98,258. And we are going to, again, assume that we're making $800 a month payment into the reverse mortgage. Over time, by age 72, our credit line will have grown to $335,624. Our balance is $69,476. Our estimated property value conservatively is over $740,000, and our retained equity is over $670,000. By age 82, our client's credit line has grown to over $723,000, and by age 85, year 2046, our client has over $910,000 in their credit line. Again, they can request these funds tax-free and have them wired into their account within 5 business days. There's no waiting period. They don't need a doctor's note. These loans are very flexible, and I'm available to answer questions for you. I hope this has been helpful. I hope you've learned something, and I look forward to answering questions and being of service to you and your clients.